Hey traders, Raghee here, and in this free recap video, we're going to cover what essentially is just another day, another down market. And we've been talking about it for quite some time, whether you're watching the premium videos, free recap videos, whether you're joining us in the simpler futures chat room. We've been talking about this downtrend, not just around October 10, although that's certainly where the price movement proved the hypothesis correct, but we've really been talking and preparing for this since August, September. Now, a lot of folks might ask, okay, Rog, what do you mean preparing? Like, what exactly does that mean? What that means is we start to accept the fact that there are certain clues out there in the market showing that there is a certain resilience in some of the names that you wouldn't consider to be sort of the sexy names of the uptrend, meaning it's not tech, it's not consumer discretionary, it's not a lot of those names that have been moving higher with the market in general, XLK, XLY, the larger index futures themselves, or the coordinating ETFs. We're talking about a market that suddenly started to see utilities hold up well. We started to see a market like staples, again, hold up well, not outperform their, again, we'll just call them our sexy counterparts right now, but they started to hold up. And then take a look at XLP, take a look at XLU, and the fact that on a down day in the larger averages, once again, they're moving up higher. Now, you might ask, well, Raghee, how come they're not in really great uptrends yet? And I'm going to tell everybody here, and some of it might be tough medicine. Some of it you might have to look in the mirror and say, look, am I one of these people? The market really still has not accepted that we are in the throes or the distribution market trend that precedes a longer downtrend. Now, this doesn't mean I'm looking for a crash. This doesn't mean I'm looking for 2007, 2008. Not looking for that at all. But what I'm saying is this market isn't in an uptrend. The data doesn't support the uptrend. And one of the things that we'll talk a lot more about is the fact that the tax cuts earlier this year, basically Q1 of 2018, are not going to be repeated in Q1 of 2019. And that tax cut allowed a lot of these companies to buy back shares. And that's why we're seeing a lot of the zigzag. In other words, revenue and guidance is actually sometimes lackluster, a miss, not as good as expected, or guidance is fairly sour for 2019. But earnings per share has been in some cases a major beat. And the reason for that is buybacks exaggerate earnings per share because there's fewer shares out there. And that's one of the byproducts that you'll see of these massive buybacks. So I don't mind seeing the strong earnings per share, but it better be coming with strong revenue during this earnings season and strong guidance, or at least better guidance than what we're hearing. So that's one of many, many reasons I'm so bearish. So look at XLU and look at XLP, and even to a certain degree look at XLV during down days in the market. Now the other thing is, let's say you're one of the folks that's saying, okay, Rog, I get it. I think you're right. I think this has been a long time coming. I think the passive investing crowd isn't even fully engaged to the downside yet because we have yet to see Apple roll over. And if you're of that opinion, and that's pretty much what's going on in my head, we haven't even seen what this market could do until Microsoft starts to look a little bit more like Amazon and until Apple starts to look a little bit more like Microsoft. In other words, those three big names, heavily weighted names within the S&P and the NAS, we're still seeing Microsoft hold its own, and Apple really hasn't given up yet. Now you might say, well, maybe Apple's not going to give up. The tide's going out, and as big a ship as Apple is, and perhaps even as big an engine as it might have to power against an outgoing tide, it will eventually succumb to the tide. It just hasn't yet. And that is when we're going to truly see some more downside. Now, I know this may be something where a lot of you may not want to hear it. And this is what I'm going to tell you. This is why I give you all so much supporting evidence. Look at the rotation during down days, where it's going and why. Take a look at gold, which is looking like a market that's ready to move up higher for the first time in quite some time. Take a look at the bonds, and I don't mean just the long bond and the TLT, but take a look at the 2, the 5, and the 10. They're starting to already show signs of some neutral, if not slightly bullish tendencies on the charts, which means yields have peaked, okay? And that mimics what we're already seeing also in the typical signs of any kind of market top. And I also believe inflation has peaked. I think GDP has peaked. So what I would love for everyone to do is start thinking about on rallies, kind of like what we had this morning. Take a look at a longer term intraday, like a 240, maybe a 480, or even a 180. But take a look at those longer term intraday timeframes and start to position yourself short when they rally up into the 34 EMA wave. The Dow did that today. The S&P did that today. The NASDAQ did that today. The Russell did that today. So keep an eye on those kinds of moves on longer term intraday timeframes and get short into that. And I think this is the kind of trading we're going to be doing for some time to come. If you're intraday 1 minute, one of the things we do in the room is we look for the overbought, oversold VWAP. So sometimes we're long, mostly we're short with a tendency, a conviction, a directional conviction to the short side. But we're definitely looking at intraday, being a little bit more nimble. But on a 1 minute chart or a 3 minute chart, what's it matter, what I think the market could do for the next 20 or 25 minutes, hypothetically. So if you like the more nimble trading and you think you might want to be a buyer too, think about the list of names where the money does seem to be rolling into. Think about that kind of sector rotation, if you will. There are opportunities still long this market. Take a look at some of the more, the stronger relative performers in healthcare, in utilities, in staples, even in housing. Take a look. You don't have to be a bear across the board, but you have to think about where the money's going to flow. I'll see you in the next update.